What is deferred income? How does deferred income impact operations? Are there any downsides to deferred income? Let's talk about it. Deferred income is also known as deferred revenue, unearned revenue, and unearned income. In accrual accounting terms, deferred income is cash received for goods or services which has not yet been earned. In other words, deferred income is revenue received for goods and services to be delivered in the future. Deferred income is recorded as a short-term liability on a nonprofit organization's balance sheet, the statement of financial position. Some common examples include workshop registration fees received in advance before the event, membership dues received early before the next fiscal year, early payments of tenant rents, and early receipt or ticket sales for future events. Why is deferred income treated as a liability? Because it is for products or services still owed to patrons and customers. Think of deferred income as a liability this way. We owe these early paying patrons and customers one of two things: the service or the product in the future, or a refund of their money. Deferred income is part of accrual basis accounting practices. Revenue is recorded when earned, expenses are recorded when incurred. Since deferred income is not considered revenue until earned or realized, deferred income is not reported on the income statement activity. Instead, deferred income is reported on the balance sheet, statement of financial position, as a current liability. As income is earned, the current liability is decreased on the balance sheet, and revenue is recognized on the income statement. In other words, after the product or service is delivered to the customer, the liability disappears, and revenue is now considered earned. How does deferred income impact operations? Deferred income is a normal part of commerce. It corrects for timing imbalances on financial reports. It aligns revenue to actual delivery of activities, programs, and services. And generally, early receipt of cash proceeds has many benefits. What are the benefits of deferred income? It helps improve cash flow. It allows a better matching of revenue and expenses. It helps with assessing the draw or popularity of a program, product, or service. It improves early monitoring of trends, and it allows for early promotion of events, products, and services. Are there any downsides to deferred income? First, could provide a false sense that cash flow is strong. If not monitored closely, could lead to mismanagement of cash funds. Deferred income could be recorded in the wrong period, when received instead of when earned, causing errors. And if the event is canceled, refunds might have to be issued. To wrap up, deferred income is a normal part of operations for most nonprofit organizations. It can have many positive impacts, but the organizations that do not have a good accounting system controls and management practices could be a problem. Best to plan to have deferred income, but watch cash flow projections carefully and keep your eye on future outcomes. That's it for today. For more information, visit the website at SE4Nonprofits.com. Also, check out our video on accrual basis accounting. See you next time.